Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Today's podcast is brought to us by our friends at Y-Charts. Hi, everyone. Welcome to the latest Carson Facts versus Feelings with Ryan and Sonu. Sonu, this is episode 62, if my math is right, titling this one, Welcome to the Year-End Rally. The year-end rally that felt like no one believed in this time 4 weeks ago, and now everybody's a bull. We're going to talk about the year-end rally. We're also going to take a look at the consumer, Black Friday. Consumer still looks pretty healthy. We're going to talk about some things there. Then we're going to talk about why this time is different. And we all know the four most dangerous words. This time is different. Sir John Templeton, we're going to show why this time is indeed different. But Sonu, on the YouTube channel, you're sitting there. Let's see your shirt. If you just kind of pull that shirt up here.
Yeah, there we go. There we go.
One Love. You are back from Jamaica. Tell us about your, I guess, Thanksgiving / holiday to Jamaica.
Yeah, it wasn't. I don't quite have dreadlocks, but the least I could do is get a T-shirt, and I'm a big Bob Marley fan. I mean, who isn't? No, it was a fun trip. It was nice to be at the in-laws. I'm very fortunate, blessed to have in-laws. I like spending time with, so that's nice. And my wife's parents and her brother and kids and all of that. So it was a blast. It's one of those all-inclusive resort things. But Jamaica's like a vibe, right? Like, the culture of Jamaica comes into the resort, even if you don't leave the resort. And, it was a lot of fun. A lot of water, a lot of sunshine, sand. What more do you need?
Was there a lot of Red Stripe? Isn't that the Jamaican beer? Did you do any Red Stripe beer when you were there?
I don't know how much I'm allowed to say on the podcast, but that was some.
You could sip something. Sip something. All right, that's all right. Okay, good.
I'm a cocktail person. I like cocktails more than beers. I think. I mean, So I like.
Well, you took me to a cocktail bar in Chicago, and I'm fully aware of. Those can be fun. But let's get into it. So again, you're kind of getting back on the saddle, so to speak, after a fun Thanksgiving there in Jamaica. But let's talk about it, Sonu. Well, I mean, mine was fine, standard stuff. Sports didn't really go the way I wanted them to. I'll just leave it at that. Joe Burrow's out for the year. Ohio State loses, and it's like, oh my goodness, this is not good. But it is what it is. Had a good Thanksgiving. Everything was fine. Now just getting back into it, looking forward. By the time people listen to this, I'll probably be in New York City. I love going to New York City.
Oh, nice.
Doing something with Think Advisor. There's a Think Advisor event there. Going to do some live media when I'm there as well. So just go to New York for about a 24-hour trip. Well, maybe 26-hour trip, which would be fun. In and out. I like it that way.
You're collecting an award, right?
I don't know. I'm the eye candy. I'm just supposed to go up there and smile. I think we are. I don't know. I don't know if they told us officially, but yes, in theory, if Carson Group is to get an award, I'll be one of the people, one of the low on the totem pole people to be up there smiling, collecting an award. So we'll see. We'll see. But hopefully, a big fan of Think Advisor. They're an awesome group, so we're looking forward to that little shindig in New York City on Tuesday night. All right, Sonu. So let's talk about it. The rally that 4 weeks ago when you and I did, I think we called it Houston, we have correction. It felt like the world was ending. You and I were hearing from so many concerned. Our partners were concerned. Their clients were concerned. People were very worried. And we said, we think there's going to be a rally. Did we think we'd have a 4-week rally of more than 10% the past 4 weeks? No, we probably didn't expect that. But if you go back and listen to the podcast, we were saying it looked like one of your seasonal late October lows. We expected November to be strong. The time you and I are recording this, November's up like 9% for the S&P. No, we didn't think it'd be quite that much, but we still expected to see a pretty good sized rally. What in your eyes sparked the move we've seen the last 4 weeks? And it's probably not just one thing. There's probably a couple. What do you think has really sparked this thing?
I'm a macro guy. I always try to connect it back to the macro policy world. So there's some bias there. It's never one thing, right? With these things, The seasonality has always been strong over here. November is a strong month. December is also a strong month. But I think it was that inflation report, right? It was a couple of podcasts ago when we talked about it. The inflation data came in soft. It was softer than expected, but the headline inflation, core inflation, all of it, right? And that suddenly changed the conversation of the Fed-related conversation from higher for longer to, oh, maybe they're going to cut. And then the question is, when are they going to cut? I think that's a big change.
Yeah, no, I agree. I mean, we talked about a lot of the sentiment things we were looking at. We saw like record selling of equities from the retail crowd in October. We saw record institutional selling in September, and it followed up in October. There was a lot of negativity. Then the realization, listen, there's no recession coming. We're a broken record. We've been saying no recession for well over a year now. So many others have been talking about that. And then we just needed something to happen, and the likeliness that the Fed is done hiking, maybe even some cuts in the next year, which you talked about. But I want to point out some other things here about this year-end rally, if I could. I get my paper up here.
All right.
December for the S&P 500 is up 1.4%. Pretty solid. That's the third best month. Only November and April been stronger, but still really solid. In fact, no month is up more often. It's like 3 out of 4 times. December is higher. So no month is up more often. It's still pretty solid overall, I'd say. But a pre-election year where we are right now, that doubles, nearly a 3% average return, a very, very strong return pre-election years, and it gets even better when you're up at least 10% for the year going into December. My question was, is there a chase? We saw last year the opposite of this. We saw weakness. The market really puked into December as a lot of people were selling due to taxes and different things going on. Could the opposite happen now? So when you're up at least 10% for the year going into December, the month of December has been higher 17 of the past 20 times, and actually 12 of the past 13. So yes, you can have a chase. Now let's add one more cherry on top. Yeah, cherry on top here. In a pre-election year, when you're up at least 10% going into December, the last 5 times, December has been higher for an average return of more than 5%. We're not necessarily saying we're going to see a 5% December. Sure. What I am saying, this year-end rally we've been expecting, maybe could have a little pullback here. We've had a heck of a run, but it could be a buying opportunity. Now, for you, why is this? Is it true that, something to do with institutions that have missed it, just buy? I mean, why do you think we've seen historically, as I just listed, a lot of strong Decembers when you have a strong year going into it?
I think it's a chasing aspect of it, right? I think I saw a good chart from you the other day, this maybe a week or two ago, showing how commodity trading advisors, who usually bet on both sides of the market, they bet on things going up, they bet on things going down, right? They short as well. So they've been net short, basically betting that the equity market would go down. And now, goodness, 9% November? And now the S&P is up 20% for the year. So if you're short of that, if you're sitting with maybe a 1% or 2% return, you're like, wait a minute, I need to get back on the, on the bandwagon here, so to speak. And, and then there's a little bit of a chase into year end that could work. And maybe that's said. I mean, that's why the Santa, I was going to ask you when the Santa Claus rally starts, because it feels like we're there already.
It does. And on the YouTube channel, you can see my color here. I'm kind of wearing a red, Christmassy holiday color. Not so much red because there's red on the screen, ladies and gentlemen. There's a lot of green on the screen. But yeah, technically, the Santa Claus rally is the last 5 trading days of the year and the first 2 the next year. And we'll talk about that when we get there. But so many people think, oh, it's a Santa Claus rally. Well, not really. It's just usually end of the year. People feel good. They're spending. We'll talk about the consumer next. You get that upward bias. And usually when you don't have a lot of news, you have an upward bias. Around holidays, historically, stocks tend to do well if there's absence of news. Usually it's not as much news in December for that matter. But I will also point out this here. So the S&P is up 4 weeks in a row, and it's up at least 10%. It's up over 10%, right? So a 4-week win streak, up 10% during that time. What I looked at, though, was persistent strength. What I mean by that, Sonu, anytime we saw at least 3 out of those 4 weeks gain more than 1%. This time, actually, all 4 weeks are up more than 1%, and you're up 10% total over those 4 weeks. But some persistent buying. I'm not talking just one big week and then you go sideways to down. I'm talking up 4 in a row with persistent buying. Happened only 10 times. This is the 11th that just triggered. 10 times since 1950. 1 year later, higher 8 out of 10. pretty good win streak. Winning percentage, I should say, up 17.6% median. Now, here are the most recent signals. These dates might ring a bell for some people here. January of 19, October 2011, April 2009, and November 1998. 1 year after those four most recent triggers that we just saw, S&P up 24% on average.
Wow.
That's not too bad.
I like those odds. I like those odds. Let's take it. And take it and run with it, right? And that's the thing, right? The more people see, I mean, it's ultimately, we've talked about this literally since day podcast episode number 1. Momentum begets momentum, right? You get some positive momentum. Right. People are stuck on the other side of it, and there's chasing, and then there's even more momentum, right? So there's a reason why, you talk about thrust, breadth thrust, and all of those things, right? It's ultimately telling the same thing, like momentum begets momentum, I think.
And that's interesting. So we did talk about the Zweig breadth thrust recently, which simply put is when you're very oversold and go to very overbought within 10 days. And we talked about that. Very, very bullish results. Callie Cox, friend of ours. I think she's at eToro. Should know where Callie works. Callie over at eToro. Callie noted last week all 11 sectors on the S&P 500 were higher. But she also pointed out all 11 sectors were higher the week before. Okay, so that's 2 weeks in a row. All 11 sectors are higher, which is interesting because I'd heard only 7 stocks were going up. So it's quite interesting. But then Callie also noted the last time we saw that, Sonu, was June of 2020. Believe me, terrible time for the headlines, but not the worst time to think about this market broadening. I think the market bottomed in March. We get it. And off those lows, we heard a lot of the same things. There's only a few stocks going up. It's only a short covering rally. Then the market started to broaden out with a lot of participation. You and I did a morning call just this morning. We looked at the returns last week. It wasn't like one sector was just doing great. It was like all 11 were doing nicely. We've seen it 2 weeks in a row. You want to talk about that?
No, exactly, right. And when you have more participation, look, even with the Magnificent Seven, so to speak, right? It's not, you want the winners to do well. You want I think you've said it before, so I'm stealing this from you, that you want your best players to be on top of their game, right? And the top 7 stocks are the largest stocks in the S&P 500 index, and you want them to do well, right? But then there's a drag effect. Everything else is also doing well at the same time. That's starting to rally, and that, whether you look at sectors or even, smaller stocks, mid-cap stocks, small-cap stocks, that's also rallying. Yes, they've underperformed the large-cap sector this year. It's because of the Magnificent Seven, all of that. But, it's a good sign that they're also participating, so to speak.
Yeah, no, they've absolutely been participating. I did double check. Callie absolutely works for eToro, so I got that right. Let's see. So, we've gone about 10 minutes or so. I think we want to move forward. So, anything else about the equity market, potential year-end rally you want to touch on before we dive into the consumer?
I just want to see more of it and into next year.
Well, I believe that's called fear and greed. That sounds a little greedy. I hear you. I hear you. And that's one thing, now everybody's bullish. Believe me, I don't think it's as simple as everybody's bullish now, but it's amazing what a 10% rally over 4 weeks can do for psychology, which was where we were with a lot of negativity.
I have a question on that. Do you think, yes, sentiment has turned, but do you think everyone's bullish even now? It feels like everyone's still upset about, you throw one chart up on X or Twitter, whatever you're calling it these days, and everyone's like, no, you can't be that positive. You can't be that optimistic.
No, well said. No, absolutely not. I don't know if I can make guarantees, right? We live in a world of compliance. We can't make guarantees, but it sure feels like the majority of the retail crowd that I get to talk with, I speak with, and you do as well, is still very, very skeptical of things. It's funny when you mentioned that I was taking a drink of water, I nearly shot the water out my nose because no, we're not seeing, I think, near the optimism that we've seen before. So again, near term, maybe a little pullback, but you're right. I mentioned before Thanksgiving, right? Everybody's like, what are you going to mention at Thanksgiving dinner? Just in general to get the table talking. And I threw out a tweet to, hey, be sure to mention FICO scores at an all-time high right now. I'm sure that'll go over well at the Thanksgiving turkey dinner. And again, it is what it is. And then, just go find the tweet when I did it. So many people are pointing out, well, FICO changed the way they look at it. It's not the same as it was. And I'm not disagreeing with that. I'm just saying, pointing out something positive. We're going to talk about the consumer here next. We're going to point out some real positive things. It just doesn't feel like people are experiencing, I guess, the strength that we're seeing. We can't really put our hands around it, to be honest. There's just a lot of negativity, even in the midst of truly, which is a pretty good economy and honestly a really nice stock market. Anything else there, Sonu?
No, I mean, the stock market's up 20%. A little more this year to date. Over the last year, the economy has grown 2.9%. The unemployment rate is below 4%. It created close to 2 million jobs over the last 12 months. I mean, like, could be, I mean, the channel, somebody from Friends, and like, could we have a better economy? I mean, maybe. I don't know. I mean, how much more could we get?
Yeah, no, well said. And when things are too good, too perfect, I've said before, like one of the last times things felt really good, I think, was in late 2019, right? The Fed was out of the way. The economy is moving. The stock market's up like, I don't know, 20 or 30% that year. I forget exactly. It was a really good year. And then a 100-year pandemic happened, and it reminded us all that the good times do come to an end, much like the bad times also eventually come to an end. So it's funny. We'll talk about the consumer next, and I'm helping the consumer. We've talked about, or the economy. We've talked about this. We got recently a new dog, Mabel is her name. She was 19 pounds when we got her. She's a great Dane. Now she's like 50 pounds. We got her like 2 months ago. So go figure. And it's funny. I'm holding this pin. I don't know if you can quite see this. See how it's all destroyed on the YouTube channel? This was Mabel. Wow. This was Mabel. Okay. She's just a destructive puppy. She's destroying our house. In other words, I think I have to like redo most of this house because of what Mabel is doing to our house. So we, the Detrick family, are trying to help the economy by having my dog destroy everything, including this like 99-cent pen that I'm holding as we speak here. Do you guys, do you guys have any animals, Sonu? Chicago, it's a little harder, right?
Yeah, no, it feels like everybody around my block here has a dog, but not me. I mean, I didn't really grow up. I fantasize having a pet, but I'm terrified about the work that's involved and everything that you're going through hasn't helped ease my, my fear of having a pet.
I mean, so we have 140 pounds, actually 142 pounds. He didn't get the best review at his doctor the last couple weeks. Walter, he's my Great Pyrenees. He's like sleeping right next to me. This dog has slept through TV more time. I'm not literally do TV right here. My dog's just sleeping next to me. He's literally sleeping there during the podcast. He's barked on his podcast once or twice. Whatever, it's fine. Okay. But yeah, we had a pretty good thing going with just Walter. Big old dog, sleeps 20 hours a day, loves everybody. He barks. He hates the UPS man. He's more a FedEx guy, whatever. But nonetheless, as a joke my neighbor told me, I thought that was funny. Nonetheless, we had a good thing going, then we had to go get Mabel and mess it all up. But that's all right. Sonu, let's talk about that consumer now. We're going to bring things back in here.
Yeah. You want to talk Black Friday?
Yeah, let's go ahead and talk Black Friday. Do you have any stats there? I know a friend Tom Lee had a great tweet. You want to talk about some of the stuff Tom pointed out?
I know I bought a bunch of stuff for the Christmas tree, and the tree is up. No, that's what I did on Saturday. But yeah, no, look, Tom Lee, a friend from Fund Strat, he was in the podcast a couple of months ago, or a few more than that, really. So,
jeez, I don't know. Yeah, it's a while ago.
These are anecdotal data, as he put it. Like MasterCard spending, Black Friday sales are up 2.5%. Shopify said merchants on its platform set a Black Friday record, 4.1 billion sales, 22% year over year, right? And Walmart CEO said, there's some discounting going on. Prices have fallen. That's the other thing, right? All these numbers we're seeing, really good, spending numbers. These are nominal numbers, right? It's not adjusted for prices. But here's the thing. If you look at CPI for goods, take our food and energy. It's just CPI for core goods. That's flat year over year, maybe slightly negative, right? So in your head, when you're looking at all these spending numbers, Black Friday, all of that year over year, think about that's pretty close to real spending, to real volume, real increases in actual volumes of goods being purchased, right? So, that's pretty impressive. I'll put it that way.
You're right. I mean, the time you and I are recording this on Monday, today is technically Cyber Monday, which, I mean, if you have a personal email, my goodness gracious, I've got about 90,000 personal emails about Cyber Monday. Didn't buy anything, but it feels like a lot of people are doing their Cyber Monday shopping earlier, because I saw some of the reports at Thanksgiving now. I've seen record online sales. I know we did or my wife at least did some online shopping on Thanksgiving indeed. So
looks like Cyber Monday started in 2020, and it hasn't ended. But here's another one, Adobe, right? Black Friday, shoppers spent a record $9.8 billion online. according to Adobe Analytics, right? Demand for electronics, smartwatches, TV, audio equipment, all of that boosted online sales by 7.5% compared to last year.
Well, I'm going to have to buy some new pens thanks to my dog chewing up this one. So I'm going to try to help. Try to help there. So let's talk a little more about that consumer. You know, we've heard $1.1 trillion in credit card debt. That data comes out from our friends at the Fed about every quarter or so, and it does keep going higher. But Sonu, you shared a really, really good chart. I'm assuming you shared it. I don't know where you first shared it. The one about debt to equity balance sheets. Where'd you first share that? Then we'll talk about it. Well, I saw it this morning in the call we did.
It was in a blog from a couple of weeks ago. It sort of went under the radar.
It must have gone under the radar. I missed it then, but this might be a little hard to explain. I hope you can explain it to the best you can to the listeners, but it just simply looks at like assets and liabilities, right?
Yeah.
There's always going to be liabilities, but the truth of the matter, consumers in a lot of cases are actually in better shape now than they were pre-COVID. I know people get upset when they hear that, and a lot of the reasons is people's assets and net worth, thanks to their house, thanks to equity prices, are truly worth a lot more than they've been worth the last couple decades. You want to dig into some of the things you found?
Yeah, so part of that credit card data that you just cited, $1 trillion, right? That's total credit card debt. So if you look, along with that data, the Fed puts out other data for households. On the assets, on the liability side, along with consumer credit, there's also mortgages, along with liabilities, student loans, etc., things like that, right? And there's also assets, right? That's the good side of things. With assets, there's, equities that all of us own, defined benefit pension entitlements, deposits, real estate, a big one, right? And bonds as well, right? Bonds, a lot of people own bonds too. And then, like I said, deposits, stay in savings accounts, money markets, things like that, right? So if you take assets on one side and liabilities on the other side, right? Assets are now, assets minus liabilities. And you have to normalize this somehow so that we can compare it to history, right? How do you normalize it? Normalize it with income. Right? It's sort of like debt to GDP almost, right?
Yeah.
For the households, right? You're looking at total net worth as a percent of disposable income is now 7.5 times, right? Household net worth is 7.5 times disposable income. Before the pandemic, it was 6.8 times. And that's basically because asset values have increased. Real estate prices have gone up, home prices have gone up. That's helped people. Stock prices have gone up, and people have a lot of cash on hand in deposits and money market funds, right? Whereas liabilities, if you look at that as a percentage of disposable income, that's barely changed, Ryan, from before the pandemic. In fact, liabilities are right now about 100% of disposable income. That's pretty much where it was in the 1990s. Whereas you look at the great financial crisis, what happened, right? It's because households were a lot more leveraged back then. Liabilities in 2007 as a percent of disposable income was about 135, 140%, right? It's close to 100% right now. And assets are a lot more than they were back in 2007 as a percent of disposable income. So I think the households are basically in a much better shape, pretty much the best shape ever, Ryan. I mean, really. And
someone just threw a shoe at you, I think, for saying that. Yeah.
But that's the thing. Like it's like everyone's waiting for the next shoe to drop, right? Oh, the consumer is going to go down, or consumption is going to fall, unemployment rate is going up. And we had a whole episode on the unemployment rate last week with Claudia Sam, probably the best person to talk about it. And she mentioned the same thing as well, right? She had a very good post on Substack last night, today. I mean, this is on the day we are recording on Monday, November 27th. I definitely recommend that. And she was trying to get to the fact that, are people financially better off compared to 3-4 years ago before the pandemic? And they are, right? Like net worth is up. And even if you look, you could say, okay, that's because, some of the comments I saw on X or Twitter was like, oh, that's because the 1%, things like that. No, across the board, across the distribution, we saw median net worth up 37% between 2019 and 2022. This year, asset prices have only gone up because stocks are up, real estate is up, everything's up. So it's not like things have gotten worse this year. So yeah, we're in a much better place across the distribution, even for people, below the 50% mark in terms of income and net worth.
No, I think you and I talked about that a few weeks ago on the podcast. Just the majority of the net worth, if you look at the percent change, has absolutely come from some of the lower income brackets. Where I'll be honest, in the 80s and 90s, and a lot of the 2000s, 2010s, to be honest, until COVID, it was the 1% that was getting most of the net worth and most of the increase in pay, so to speak. That has drastically changed the last couple of years. So that's one potential positive thing. I think the next part of this is maybe our final conversation. We're going to talk about, well, what about higher yields? How does that impact everything? But anything else on the consumer you want to talk about before we go to that final part, Sonu?
I mean, there is a nice segue that this time could be different, right? I mean, I think just this time could be different. We're talking about a very income-driven cycle. People have more incomes, and that's what's driving spending as opposed to debt.
Yeah, and before we even go there, I'll point out, the interview with Claudia was awesome. She was awesome. You just ask her something, and she just starts talking, and she didn't even really, maybe she go on a different tangent, but it's really, really good stuff. I did the interview. I listened to it twice, just trying to get everything that she said, because I don't remember, sometimes you do these when you're the person doing the interview, you're thinking about the next question. Maybe you're not always listening as much as you should be, I'll be very honest. But still, the stuff that she said was really, really awesome. And she pointed out, this was more a supply issue, not a demand issue coming out of COVID. Some of these unique things as we go forward. But again, this time is different because she started that kind of conversation. So this time is different. So, we had 8% mortgage rates. You've got 30% credit card rates. I just bought a car. I got my daughter, Susanna, just got a Jeep. What did we get her? A Jeep Wrangler. Wow. I was like, ooh, wow. Rates are higher than they were when I got a car 4 years ago. It's like nothing's really changed on my front, but it did cost more to get a car. So I saw it and felt it firsthand just a few weeks ago. But again, the truth is, why is it though? Why in the world did we just see the Fed hike rates from 0 to 5.25, 5.5 approximately, soaring longer into the curve, right? Soaring mortgage rates and places like things like that. Why didn't it impact the consumer more? Is there an easy way to put it, or is it a complicated answer?
I think there is a simple answer, right? The simple answer, I like to think of monetary policy as, the way it works is, in the immediate term, the way it works is through housing. What happened? They raise rates, mortgage rates shoot up. We literally saw the same thing. Housing crashes. We saw that. And then home prices crash. Nobody likes home prices to go down. We didn't see that this time. Why? Because everyone, when they saw mortgage rates at 2.5%, 3%, went out and either bought a new home or refinanced, right? So most people, if you look at the effective mortgage rate paid by homeowners, and by the way, the home ownership rate in American households, 66%. It's close to, relatively close to all-time highs, right? It's not far away from that. So most people have an effective mortgage rate of about 3.5%. Now, if the Fed, because of what the Fed did, the prevailing mortgage rate is 8%. What are you going to do? They say, you know what? I'm not giving this up. My house is worth more. My mortgage is worth basically less because I have, a very low interest rate on it. Yeah. So we were literally just talking about net worth. I'm not going to sell. So nobody went out and nobody's putting their house in the market, right? So because of that, there's very low existing home sales inventory. And that's pushed all the potential home buyers, a lot of them, which are basically millennials, right? 25 to 34-year-olds. And there's a lot of them, by the way. They're the largest age cohort in America right now, even more than the baby boomers, I believe.
Yeah, they're everywhere. They're everywhere. Just turn around the edge. Exactly. I think there's one right there in my basement. I'm teasing. It's just my dog. Never mind. Yeah.
All of them need homes. They want homes. They want to buy homes. They're being pushed out into the new homes market. So we're in a very different cycle, right? And that is why 8% mortgage rates didn't kill the consumer.
Yeah, so I want to point out some other things that I found. By the time you listen to this, or whoever listens to this, you can go to carsongroup.com. There should be a blog on this with some of these stats I'm about to talk about. Michael Batnick over at Animal Spirits, Ritholtz, he pointed this out. Huge fan of Michael and his awesome podcast. He mentioned some data from the Fed and Morgan Stanley that 90% of all debt was fixed for households going into 2022. So if a lot of this debt was fixed, like what you just talked about with some of the big purchases and your houses and things, 90% of it was fixed going into 2022 before rates and yields spiked higher. That's one big reason the consumer did not topple over when we had that. Now, also, Sam Rowe pointed this out. Sam Rowe, obviously, over at Ticker, been on the podcast a couple times, big fans of Sam. He shared data from Goldman Sachs recently. 46% of all S&P 500 debt is set to expire after 2030. Okay, so like half of all the debt is locked in. Now, who knows where it's really locked in, but probably a lot lower than where it is this year, right? So again, that's one of the main reasons overall how do I put it? The balance sheets of corporate America have been really, really strong. And lastly, Blake Millard, he does some great work. I'm a big fan of Blake as well. I know you are as well, Sonu. He noted this one looks at small caps versus large caps. So look at the Russell 2. This data did come from FactSet, but Blake shared the data. 51% of all debt for Russell 2000. This is as of the end of last year, into 22. 51% was fixed. So that's not much. That's like half is fixed. So the other half could change if yields go higher. That impacted small caps this year. Large caps, S&P 500, 91% of all debt was fixed as of the end of last year. I think that tells a really good story. I mean, that's good. It's another easy way to put it. An easy to understand story of why small caps have struggled so much because, higher debt hurt them, but it didn't hurt these really large companies. Look at what Microsoft did, Apple did, IBM, all these big companies a couple of years ago. They locked in debt at historically cheap levels. Was it dumb luck? Was it not? I don't know. But the bottom line is the big surge in yields have clearly not impacted. I mean, look at tech. Tech's up like 50% this year. Who knows? By the time people listen to this, the NASDAQ 100 might be at all-time highs. I know it's like 3% away, but who knows when you listen to this. Yes. The truth is these large companies haven't been impacted. But let's put a full circle on this. We've liked small and mid caps since about the middle of the year or so. Clearly, there's a struggle there, but they've done well all of a sudden. So if we know what we know, which is higher yields impacted small and mid, we know it. Now, if the Fed's done hiking, like you and I talked about 2 weeks ago and with Claudio last week, are small and mid, is it finally their time to take the baton and shine a little bit?
And I would add to the Fed being done, there's a potential, like what's not being priced in, right? What potentially could not be priced in for going into 2024 is the fact that, inflation could be coming down pretty quickly here. Especially with the rents going down. We're still seeing disinflation, a lot of deflation really in used car prices, things like that, as production ramps up on the automobile sector. So if inflation comes down to, look, the Fed's already told us in their dot plot, in their projections, said, if inflation comes down to 2.3%, we will cut. We'll cut by about 1.25 to 1.5%. Now, they're expecting that to happen only by 2025. But what if it happens by 2024? Now, I don't think they're going to cut 1.25, 1.5%, but you could still see 2-3, rate cuts potentially next year, starting in the middle to second half of next year, right? I think that's going to be a massive tailwind for mid and small, especially. And we don't have to wait till it actually happens. The markets are going to, as you say, sniff it out earlier.
Yeah, I mean, I've done this for a long time. This being, work with investors, work with advisors. People say, well, I'm going to wait till there's a little more clarity. Let's just say if you wait till there's clarity and the Fed finally starts to cut, the market has probably sniffed that out. You and I talked about this 2 weeks ago. The idea of productivity in our country has struggled overall the last couple decades, to be honest. But we've seen a lot of productivity the last 2 quarters. We think there could be a lot more productivity going forward. The last time we saw strong productivity in our country was in the mid to late 90s. Another period where the Fed hiked aggressively in 94. Said, oh, you know what? The Greenspan sniffed out the better productivity and a strong economy, so he cut a few times. Market took off like crazy in early 1995 as it sniffed out those cuts coming later in 95. And we all remember what happened in the mid to late 90s. We're not calling for that exact type of scenario, but I think we're thinking that there's a lot more similarities between now and the mid 90s. A lot of people think when you look at the idea that productivity, which can put a lid on inflation, but also allow for stronger wages. I mean, how great is that? Low inflation, better wage growth, higher productivity can do that. I mean, Sonu, that's a lot of your, I just summarized what you've taught me here the last month or so. Did I say it right?
No, absolutely. And, I love how you've basically, for all of you listening and or watching on YouTube, Ryan's teased quite a bit of our outlook right there, outlook for 2024 and even beyond, right?
Yeah.
We manage portfolios that are that have relatively shorter time horizons, 6 to 9 months, things like that. Those are tactical portfolios. But we also manage strategic portfolios, right? And we like to be, be recognized. Yes, you can just go use like a benchmark type portfolio, put 60% here, 40% there, be done.
Yep.
But we like to think ahead, right? And part of our thinking goes into exactly what Ryan just mentioned about productivity. And that's going to be reflected in our strategic portfolios.
Oh, no, absolutely. So again, this was episode 62 of Carson's Facts versus Feelings with Ryan and Sonu. What did we call it? Welcome to the year-end rally, where we talked about the year-end rally, the consumer, and then again, why this time might be different. All right, Sonu, thank you for hopefully better late than never on that one. But anything else you want to add before we sign off?
I'm just looking forward to a good December here. I mean, that's part of, I think a lot of people think, oh, the market rally is done. But I think one thing to keep in mind, as we always talk about, momentum's always a good thing. And there's good reason for some chasing to be taking place into December and into the first week of January too. So fingers crossed, Ryan.
Yeah, I mean, hey, these are the 3 best months of the year: November, December, and January, right? So this is just the first one. But hey, there's been a lot of gains, right? S&P's up 9% in November. So maybe it did take away a little bit from potential gains in December, but we still think there's some higher prices coming and likely all-time highs, which are not that far away on the S&P 500 and Dow sometime probably hopefully early next year. So with all of that, again, this is episode 62 of the Carson's Facts versus Feelings podcast. Hopefully everyone enjoyed it. Sonu, you and I will be back next week to do it all again. We'll see everybody then. Take care. Thank you. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.